Hello, everyone, and welcome back. Today, we're focusing on bank pensioners who retired on or after 18 March 2003, the group the Supreme Court identifies as Group 3 in the MC Singla case, scheduled for hearing on Wednesday, February 18th. I'm Nisha Bhattacharya, and joining me is my co anchor, Priyanka Chakraborty.
At the request of several subscribers, today's deep dive will walk you through our methodology for building the Group 3 charts. We'll start with a quick look at our data sources, all publicly available material from the IBA, the Department of Financial Services, and unions such as AIB Park and AIBRF.
To keep our analysis of a typical Group 3 retiree rigorous and fair, we use a single benchmark, a scale tree officer retiring at 60 after 33 years of service, positioned at the midpoint of the IBA pay scale. That way, the only variable we isolate is the pension regulation itself. Same grade, same service, same longevity.
Next, we carry out a basic arithmetic operation to determine the midpoint final salary range. What we're looking for here is the sweet spot, the Goldilocks zone. Not too optimistic, not too pessimistic, but just right.
Next step, we take 50% of the midpoint salary as the pensionable monthly salary, which then sets us up to apply the applicable or relevant BPS criteria for dearness relief.
If you're a retiree watching this, remember the example in this podcast won't mirror your exact situation. And that's okay. The Supreme Court isn't examining individual cases, it's looking at how arbitrary cutoff dates distort outcomes across the entire bank retiree population.
Take what we call the cliff edge anomaly, the idea that 24 hours in your retirement date can change your destiny. A banker retiring on 31st October 2002 falls into Group 2 with only 65% neutralization, while someone retiring just one day later, on 1st November 2002, gets 100%. That sharp divide is exactly what the Supreme Court is now scrutinizing.
For better or worse, that 24-hour gap in retirement dates creates a huge difference in long-term financial security, even for two officers of the same grade doing identical work.
It really is. It's a revelation about how your financial destiny in retirement isn't necessarily about how hard you work or how high you climbed up the corporate ladder. Turns out it's almost entirely about the specific calendar date you walked out the door for the last time.
Which is a terrifying thought.
So, our mission today is to decode the fate of three distinct generations of bank retirees with a specific spotlight on this mysterious Group 3.
And specifically, we need to answer a question that seems to be baffling the actuaries and the lawyers alike, which is why does the math look so different for someone who retired in 2003 versus someone who retired in 1987?
So, the nominal value, the actual paycheck of a pension for a new retiree, should naturally be higher than somebody who retired 40 years ago. That's just how time works, right?
That is the logical assumption. In almost every other industry, the person retiring today makes more in absolute terms than the person who retired in the 80s. That's just standard economics.
The MC Singla case is really a lawsuit about dates, plenty of numbers, slab SDR, DA, etc., and dates, not counting adjournments.
Okay, 50% of the last paycheck, simple enough, but the complexity comes in when that last paycheck was drawn. The Supreme Court has asked for data on three specific groups. Can you break those down?
I can, and this is critical because where you fall in these groups dictates which set of rules applies to your money.
Right? It's like you're sorted into different version of realities that determine your financial security and future.
That's a great way to put it. First, we have Group 1. These are the veterans. They retired between January 1st, 1986 and October 31st, 1987.
Okay, the pre-90s crowd, the super seniors.
Exactly. Then we have Group 2. They retired from November 1st, 1987 up until March 17th, 2003. Okay, so that's a pretty wide window. That covers the 90s, the turn of the millennium.
The whole middle cohort.
Got it.
And finally, the focus of our document today, Group 3. These are the folks who retired on or after March 18th, 2003.
So that's roughly the last 23 years of retirees.
If you retired anytime recently or in the last 2 decades, really, you are Group 3.
Correct. And here's where it gets interesting. On paper, if you just read the headlines or the rule books, Group 3 seems to be in the best regime.
It's considered the best because of how they handle inflation. In pension terms, this is called dearness relief.
Group 3 gets what is called 100% DA neutralization.
Neutralization, okay, that's a very technical term. It sounds like something out of a chemistry lab. Can you, translate that for us?
In plain English, it means their inflation adjustments match exactly what serving employees get. They are fully indexed to the cost of living. If the cost of living index goes up by 4%, their inflation allowance goes up by 4%.
A one-to-one match, no tapering, no haircut.
Okay, that sounds great. 100% protection, that sounds like the gold standard. If milk costs more, my pension goes up to cover it. So let's run the numbers for our Group 3 senior manager. The source uses the ninth bipartite settlement scale as an example.
It does. So, under that specific wage scale, a scale 3 officer started at 25,700 rupees and topped out at 35,100 rupees. For our analysis, the actuaries calculated a midpoint salary of 30,400 rupees. The retirement paycheck is 50% of the final salary.
I mean, even in 2010 money, that feels tight. Are we sure that's right?
It is right. But you have to remember that 15,200 rupees is just the basic pension. It's the static number, it's the anchor,
But in the banking pension system, the real money comes from that inflation factor I mentioned, the dearness relief.
right? The DR. So the basic pension is frozen in time. It stays at 15,200 forever, but the DR moves.
Exactly. And the DR is the heavy lifter here. I mean, it's doing all the work. It's linked to something called the Consumer Price Index for Industrial Workers, or CPI-IW.
The charts we are reviewing use a reference point of 8,028 points, which was the average for April to June 2024.
So let's watch this pension grow over time. We start with that meager 15,200 basic. How does the DR change the picture?
Right, let's look at the growth curve. In 2011, the DR was only 6%. So your basic is 15,200 plus roughly 900 in DR. Your total pension was about 16,112.
Still not exactly a fortune.
No. But watch the inflation kick in. By 2015, the DR jumps to 33.5%. The total is now 20,292 rupees. By 2020, DR hit 76.80%, pushing the total to 26,074.
Okay, so the inflation component is now almost as big as the pension itself. The allowance is becoming the main meal.
And by November 2024, the DR is sitting at 107.28%.
That's huge.
That means the inflation adjustment is actually larger than the basic pension itself. The total monthly pension becomes 31,107.
So it doubled. In nominal terms, the pension went from roughly 15K to 31K purely because of inflation adjustments.
Exactly. And if you stop reading the report there, you might think, well, the system works, it's protecting them.
I'm looking at the next page and I see a chart titled Corrected Comparative Summary, and the numbers on this chart are wildly different. We just calculated 31,000, but this chart is showing numbers in the 80,000s, 90,000s. What is going on?
Yes. And this is a crucial distinction. The calculation we just did, that 31,000, was a theoretical model to show you how the DR mechanics work. It was a math lesson.
The source notes that Group 1 received a one-off updation in May 2010. Essentially, their basic pension was recalculated and boosted significantly to bring it in line with modern times.
So they got a reset button, like refinancing a mortgage, but in reverse.
Right. Where they give you more money because of that updation, their purchasing power has more than doubled. The source calculates their real KGR, the compound annual growth rate adjusted for inflation, at plus 168%.
So they're beating inflation.
And Group 3, the modern retirees who we thought were safe with their 100% inflation protection, did they get a reset button?
No, they didn't get that updation. Their basic pension stayed frozen. So their real KGR is plus 0.01%.
0.01%, that's basically zero.
They are essentially treading water. They weren't getting poorer, but they aren't getting richer. Their standard of living is locked at the day they retired.
And Group 2, where do they fit in this growth story?
Group 2 is the tragedy of this story. They are actually losing value. Their real CGR is 0.06%. They are slowly sliding backward. It's what the source describes as near stagnation.
So they miss the big updation bump and they have different inflation rules.
They're stuck in the worst of both worlds.
This is mind-blowing. It's like an economic time machine where going further back in the past makes you richer in the present.
It is, and this leads us to the most dramatic part of the document. The actuarial conclusion calls it the cliff edge inequity.
Cliff edge, that sounds ominous. Is this a specific date?
It is. It refers to a very specific boundary line in 2002. The source asks us to compare a retiree from October 31st, 2002 versus someone who retired just one day later, on November 1st, 2002.
1 day. The difference must be negligible.
You'd think so, but the settlement rules changed. Remember the neutralization we talked about?
Right, Group 3 gets 100%.
Well, the retiree from October 31st, 2002 falls into Group 2. They get tapered neutralization on any portion of their pension above 610 rupees. They only get 65% neutralization.
Ouch, so they lose 35% of the inflation fight on the bulk of their money?
Exactly. But the guy who retired the next morning, November 1st, 2002, he enters the new regime. He gets 100% neutralization on his entire pension.
Just for hanging on one more day.
1 day. The source explicitly states that this cliff edge difference demonstrates that neutralization is not uniform, it is settlement specific. It depends entirely on which contract was in force the day you retired.
That feels incredibly arbitrary. So if you retired on October 31st, you're in Group 2, sliding backwards. November 1st, you're in Group 3, treading water. And if you retired in 1987, you're in the slightly better off group.
That is the sum of it. And the source has a verdict on this, right? I see some strong language here in the conclusion.
They don't mince words.
No, they don't. The document describes the system as actuarially unfair and constitutionally unsustainable.
Constitutionally unsustainable, that is a heavy phrase for a financial document. That's lawyers speak for. This is illegal.
It is. Their argument is that one solitary updation in 2010, that golden ticket given to Group 1, completely reversed the fortunes of the 1986-87 retirees, leaving everyone else behind. It creates a class system among retirees that has no basis in merit or service.
It really challenges the idea of equal pension for equal service.
It does. When you have a system where an older Scale 3 officer has a bigger pension than a newer one, solely because of regulatory tweaks, you have a structural anomaly.
So, what does the source suggest is the fix? If the Supreme Court is looking at this data next week, what is the proposed solution?
The source is very clear on the path forward. The call to action is updation plus 100% DA to all pensioners, irrespective of retirement date.
Basically, level the playing field, give everyone the updation that Group 1 got, and give everyone the 100% inflation protection that Group 3 has.
That is the only way, according to the source, to achieve an equitable solution. You fix the cliff edge and you fix the upside down reality.
It's fascinating that 24 was the last year of fully audited figures mentioned here. We're sitting here in 2026, and this data is the bedrock of what the Supreme Court is reviewing right now.
That's right. The numbers we discussed, that disparity between groups 1, 2, and 3, those are the facts on the ground today. That is the check hitting the bank account this month.
To recap, the current banking pension system ends up rewarding the oldest retirees the most because of the 2010 updation policy. Meanwhile, Group 3, the newer retirees, are protected from inflation but have never had their core pension updated. And Group 2 are barely keeping afloat.
It's a complex web of dates and percentages, but when you strip away the jargon, it boils down to something very human. You expect your retirement to be safe, you expect it to be predictable.
You don't expect it to be a lottery based on whether you retired on a Tuesday or a Wednesday 2 decades ago.
Well said. We're going to leave you with a final thought to mull over. We often think of fairness as treating everyone the same, but in the world of pensions, treating everyone according to the rule book has resulted in vast inequality.
It raises the question, can a system be truly fair if retiring 1 day later changes your financial reality for the rest of your life? And if the rules can be changed once to benefit one group, what is stopping them from being changed again to fix the balance?
That is the trillion rupee question.
Thank you for joining us on this deep dive. We'll be watching February 18th very closely.
Indeed, it's going to be a pivotal week in court number 2 at the Supreme Court.